Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in, Joe Caccera with Real Estate Radio Live. Thank you for those that are continuing to follow us on Facebook. We appreciate that very much. We want to, again, I'll repeat this, we want to continue to grow the audience any way we can, and social media is a great way to do that. Of course, a lot of people are spending a lot of time on social media, so we want to be able to use those resources the best that we can. So we appreciate all the people that follow us on Facebook. We appreciate the people that comment on the video while we're doing the live podcast here in our studio, and this becomes the podcast afterwards, and we distribute the podcast all over, in which thousands and thousands of people are downloading each month. And I want to, again, thank those that are watching the show today or later on if you're downloading this podcast and listening to it. And thank you personally for continuing to really promote the show, listen to the show, give great feedback, and we appreciate that very much. We work really hard to get the best guests we can and content and information to really keep you apprised of the markets, what's going on in real estate in all different aspects. I know we cover a lot of different areas of real estate, but it's not without a lot of research, due diligence, and confidence. And when we pass this information on to you, the consumer, that hope you use it to make wise decisions in and around your real estate, and that's the focus. Today, we're going to talk about the title of today's show is Rates Drop to Historic Lows, number one, and two, Buyer's Market. So I'm going to cover two things today. The rates continue to drop. They're near, when I say historic lows is a very good title for today's show because we are flirting with all-time lows in the 30-year conforming fixed money, and I'll go into the details of that and why. I sent a video out today. I did a bunch of marketing campaigns, really just to let people know to get out there and take advantage of these interest rates. They don't come around that often like this. If you look at the chart, matter of fact, there's some charts that would, if you go back to 1975, 1980, if you take a look at a rate chart, I think in 1980, 87, I bought my first house in 87. Early 80s, the rates were, 13, 14%. Later in the 80s, they were down to about 11%. And then they started coming down in the 90s. If you look at the charts, kind of a consistent kind of tick down into the all-time lows, probably hit 5 or 6 years ago, if I remember right. It might have been 2014, 2015, when I remember there was a small period of time. It might have been days. It might have been, I don't know that it was hours, but it was certainly probably day or days. The lowest I've seen, and when I say this, I know, depending on if you paid points and all these other factors, so you have to be careful with saying the lowest rate. The lowest, when I say the lowest rates I've seen in this business, and I've been doing this, in this market, and this is an industry for 18 years, is that the 30-year conforming fix was down to about 3.375 at no points. So that was kind of the general rate in the market. Now, someone would have said, oh, wait a minute, I got 3.5, or someone might say, well, I got 3.25, and that could be true. So you might have paid more or less or whatever. But the bottom line is, if you look at the charts, as I kind of use this as a metric, as going back in this business the way I know it, the lowest I've seen them at standard closing costs without paying points, 30-year conforming now. This is not jumbo. Conforming interest rates were right now at about, I think it's $453,000 or less. We're 3.375. Well, yesterday they were right around 3.5, and they're teetering right around 3.5 and 3.625 right now. Which again, keep in mind, these rates are near all-time lows. Let that sink in for a while. I think sometimes we're a little bit jaded or paralyzed in the fact that we've been in a low-rate environment, relatively low-rate environment for many years. But let that resonate for a little bit. 3.5% on 30-year money on purchasing a primary residence. Now, those rates are different if it's a rental property and a vacation home. Actually, vacation homes will be very similar. Second homes will be very similar to primary residence. Rental properties, non-owner occupied, those are more expensive in terms of rates. So I want to just let this, as you listen to this, let it resonate. If you own a home, if you own a property, one or more, take a look, do a kind of a mortgage review. Happy to do those with you as well, and see how much money you could save, or see if this makes sense. I have to believe when the rates get down to 3.5%, which they are now, and I don't know they'll be there tomorrow or next week or next month, but this is why you should take action right away. There's a lot of people just in the last couple of days. We have a ton of activity coming in, helping them with refinances, the team here, and working really hard to get them locked in and get them the best rates possible. So let that sit for a couple minutes to think about it. 3.5%, 30-year fixed money for a property. You know, this doesn't mean everybody should go out and do it, but seriously, first of all, people who are first-time home buyers, you need to get out there and hustle and get into a place as quick as you can. And I mean that because the cost of money is so low right now, it'll make a huge difference in your qualifying power. It'll make a big difference in what happens with that loan and with that property over the next 5 to 10 years. If you look at historical data in the Bay Area, I want to say the average annual appreciation is probably 6 or 7%. Let's even say it's 5%. Let's take a really low number. Let's just say the average appreciation in the greater Bay Area over the last 20 years, and I think I'm right about this, it's probably higher, but let's take a very conservative number. Let's just say you had a 5% appreciation rate in your property over the last 20 years. And now, if you're able to lock in money for less than that appreciation rate, again, these factors all spell success later on down the road when you make long-term investments. That's the reason why you buy a property. That's the reason you hold on to properties, is because this is a long-term investment for most people. And I would suggest that that's the way it is. Now, if you're forced to sell and you have to move, those things happen. So those are just going to happen, and you can't avoid those things. I've said this before, and I'm a big believer, not only personally, but I've seen it for years, and I've been in real estate for 30-plus years, almost 40. You'll almost never get hurt in real estate if you take a long-term approach. I'll say that again. My belief is you almost never will get hurt financially if you take a long-term approach with real estate. The reason why is if you go back and you look at the history, people that have bought at the peak, even the peak at markets, right? You could look at, I did it. Several other people did it. Even if you bought at peak at markets, if you write it out and you look at a long-term view, the ups and downs of markets, you're still going to win out. I gave a lot of people this example before. I bought a property in 2005 for $1.3 million. I think the peak of the market was like 2007. And then it came, as everybody knows, it came crashing down between 2008 and 2009. It started recovering, I think, in 11. And at one point, that house that I bought for $1.3 million was probably worth $1 million, maybe less. But it didn't matter to me because it was my primary residence. It was a long-term play. I mean, certainly I looked at it, I go, wow, this is crazy, but it didn't matter. I've been here long enough. I understand it. It's my primary residence. I'm not worried about it because I'm not forced to sell it. Now, a lot of people did, and they were hurt because of that. But again, let me just give you one example of millions that you could probably hear. At one point, that place was worth less than $1 million on paper and on the market. If I would have put it on the market and I would have had to sell it, I could have took nearly a $400,000 loss if I had to sell it. But today, as I sit here today, that same home now is worth probably 1.7, 1.8 easy, maybe more. So do you see what I'm saying here? If you take a long-term approach, this is one of many examples, and there's no guarantees. I'm not saying there's guarantees, but it's similar to investing in the stock market or anything else. It's hard for people to conceptualize. It's hard for people to really to sit down, even on paper, and say, gosh, okay, if I invest this amount or if I buy this many properties in the next 5 or 10 years, over the next 15, 20, 25, 30 years, this is what I could expect conservatively. You should do that. You should go through that exercise. Everybody should. The reason why that exercise is good is because it teaches you discipline in long-term hold. there's a lot of people, and I understand, that flip houses. There's a lot of people that are day traders. Same concept, right? Buy high, sell low, buy low, sell high, whatever it may be. And some people do okay with that. And it's not a right or wrong. It depends on what your strategy is. So the reason I'm going to remind all of you this as I talk about interest rates today at being historic lows, jump in and take advantage of this. So if you're a current homeowner, and if you have an interest rate that's at 4% or more, you really need to seriously think about refinancing. Now, someone's going to say this, and I know this will happen too, and I have an answer for it, believe me, so I'll try to answer my questions or my requests. So someone's going to say, I have a rate at 4% and I've been in it for 2 years. I hate to refinance because I don't want to go backwards. I hear you. But we could refinance, drop that to 3.5% and do a 20-year loan or a 25-year fixed loan. You don't have to go backwards. Okay, so just want to make sure everybody understands that. Someone might say, Joe, I had a rate of 3 3/4 or 3 5/8, and I've had it for 5 years. And for you, it probably does not make sense. Okay, there is a threshold there that depends. The rule of thumb usually, the metrics a lot of us use is 0.5%. If the rates drop 0.5%, it's probably a good chance it's smart for you to refinance if it's a long-term play with that property. Now, if it's a jumbo loan, a quartering rate can make a huge difference. If you have $1.5 million loan, if you have a $2 million loan, I know a lot of people don't, but there's quite a few people in the Bay Area that do. If you have $1 million loan or a $1.5 million loan, and you could drop your rate a quarter, that's several $100s a month for a loan that size. On the other side of the spectrum, if you have a loan amount of $200,000 or $300,000 and you drop it a quarter, it's probably not going to make a big difference. Maybe $50, $60, maybe less than that. So be careful with this, but I want as many people as you can to take advantage of these historic low interest rates. So if your rate is 4% or more, you really should take a look at refinancing. That's the first thing. Second thing, if you have a home equity line of credit or a second or anything attached to your property other than your first, it almost, to me, it doesn't matter how low your rate is on your first. I would take the opportunity right now that the rates are at all-time lows and consolidate the first and second, eliminate that exposure on the second, and wrap those into one low interest rate. That would be a recommendation. If you're thinking about remodeling, adding on, doing something, looking at a big project that you were thinking about doing for years, now is a great time to do it. Let me give you an example I heard the other day, which I thought was great. The best thing you could do with the cash out and money from your own house is to put it back into your house for a reinvestment. It really is. And there was a gentleman that was doing wants to do a total remodel on his place, and they're expensive, as you can imagine, around the Bay Area. And he wanted to pull $700,000 or $800,000 out. And listen to this: the cash out for $700,000 was at 4%, right? That was cash out, interest only. Now, first of all, when you cash out and it's an interest only, the rate's going to be higher because there's a premium there. Okay, so they're looking at 4% interest only, and the client was a little like, "Oh man, I don't know. I mean, the market rates are 3.5," and I had to explain to him. I said, "Do me a favor, go to a bank, personal, private bank, whatever. Go and find out what a construction loan costs you." And he says, "What do you mean construction?" Just find out what a construction loan would cost you if you took out a construction loan at a bank, any bank. And so he did a little research. He called me back. He says, okay, now I know what you're getting at. See, if you go to a bank anywhere and you say, listen, I want to get a construction loan, the way construction loans is you get a big line of credit, and then you use that money until the house is done, and then you do what's called from construction to permanent. Then you go back to permanent financing. But listen, while you're using that temporary money on a construction loan, that cost of that money right now is probably 6.5% interest only. So when he went through that exercise and realized, wow, now I know what Joe's saying. Why would I go through a construction loan when I could take that money on my own property, use it the way I see fit, and have it at such a small cost or low cost of 4% fixed for the next 10 years? Amazing. Great program. So these are things to keep in mind. So if you're wanting to do a construction loan, or maybe you're wanting to do a remodel, an add-on, or something where you need a big, large amount of money, now's a great time to do that. Pull it out of your home, reinvest it into that same property. It's a great thing to do. What else? Now's a great time to go to a 15-year fix. We have some people going to a 15-year fixed. I think yesterday they were down to low threes, 3.25, 3 1/8. So those are super low. I remember when the 15-year fix did drop below 3. I remember when the 15-year fix, I was just talking earlier about the conforming, the all-time lows of the conforming. The all-time lows of the 15-year, I remember people were getting 2 3/4 for a while on 15-year money. I mean, think about that. 2 3/4 on 15-year fixed. We're getting close to that now. It's just right around 3 or just a hair above 3. So now's another great time. Maybe you're thinking, gee, with rates this low, maybe I've been in a 30-year for 10 years. Maybe I want to go to a 15-year. Now's a great time to do that. You could go from a 30 to a 20. You could go to typically, here's the amortizations that typically most lenders will be fairly competitive and allow you to do. You could do a 10-year fixed. You could do a 15-year fixed, a 20, a 25, and a 30. Those are typically the amortization schedules they'll allow you to do. So now's another great time. Reevaluate that. Okay. Another thing you might want to do, let's say, I get this too. Joe, my rate's at 4.25 or 4.5, but you know what? I'm selling the house in 2 or 3 years, so you know what? I'm just going to leave it alone. No, I would argue with that. I would say if you're selling it in 2 or 3 years, let's refinance to a 5/1 ARM, get you down closer to 3% or 3.25%. Drop that 1 full percent or more on a 5/1 or 7/1 ARM. Since you're selling it in 2 years, and save hundreds of dollars a month, thousands of dollars a year in your own pocket prior to selling that house and still paying the mortgage. So these are all little strategies that some people don't think about, and that's what we do here with the team is we educate people on real estate, on financing, on all the aspects of this. We have the team here that can help with this financing. Give us a call. We're going to take care of it A through Z. Before I jump into the purchase market or the buyer's market, well, I want to talk a little bit about that too. Again, just a quick summary of what we're talking about. Rates hit historic lows. If your rate is 4% or higher, you really need to look at refinancing. Give us a call and let us help you. You may want to pull cash out. Great time to do it. You may want to consolidate a first and second. Great time to do it. You may want to consolidate debt. Some people maybe have taken on medical debt or credit card debt or student debt, and they want to wipe that out. Now's a great time to do that with a refinance as well, with rates being so low. So take advantage of them. I hate to see this time go by, and one thing that I do know before I start talking about buyer's market is that rates go down very slowly, but they go up very fast. And this is what I know because I've lived in this world for almost 20 years. They tick down slowly. So what I tell people, take advantage of them as they tick down slowly, but take advantage of them as often as you can because once they start going up, they go up quick, and then it's too late. Here's what's funny. About a year ago or so, I remember we were talking about, isn't it great that rates are at about 4.5%? Which is still, by the way, a very good rate, historically speaking. I remember a year, it might have been less than a year. It could have been 8 months. I don't know. I should look at that chart. I should have had it here. Could have been less than a year. So let's call it 7, 8 months ago. Rates are at 4.5%, and everybody was pretty happy going, rates are pretty good. Now they're 3.5%, 1% lower. All right. Take advantage of them. I hate to see people pass up this opportunity. You could save a lot of money. And by the way, it's not only saving money, it's a great investment in your real estate over the next 5, 10, 15, 20 plus years. All right, let me spend the next couple of minutes now just giving everyone an update on the buyer's market. It's still a very, very, very good buyer's market. If you've been listening to this show, you know I've been talking about almost the last year now. I've been on the bandwagon truly telling people, buyers, get out there and make your decisions now. It's still that way. My concern is somewhere down the road, maybe later this year, next year, it may turn back to a seller's market, and I hate to see those buyers lose out. I'm just seeing a normal market right now. And so when there's a normal market, let me just share with you the way this works. When we're in a normal market, which is normal right now, it's a better market for buyers than it is sellers. It's not a terrible market for sellers. It's just that sellers had their day. Believe me, sellers had a 4 or 5 year run where they were racking up the dough. I mean, people were standing in line, making multiple offers, paying them 15, 20, 30% over asking price. So thumbs up to the sellers. You did good the last 4 or 5 years. Buyers, jump in. Water's fine. Now's a great time to be a buyer. Get out there with the fact that these interest rates are at historic lows. You could qualify for more purchasing power. And we're still in this normal market, which is the best for buyers. We're seeing on a regular basis prices kind of stabilize, come down a little bit. You can negotiate now as a buyer. You have more negotiating power than you have in the last 4 or 5 years. Take advantage of it. This is a great time. So for those people who are listening to this podcast or watching it, again, I'll repeat this. This may not always apply to you. Do yourself, your friends, your family, your coworkers a favor. If you know someone in your family, friends, coworkers that's thinking about buying a home, selling a home, refinancing a home, pass this podcast on to them. Get that information to them. Allow them to educate themselves and help them make wise decisions financially when it comes to their real estate transactions. That's what we do. That's what we want to do. We want to help you with that. And we'll continue to do it. That's what we do here, and we'll continue to have great guests and information and content to hopefully pass along to you. We have downloads, again, thousands and thousands a month. The majority of our downloads are in the Bay Area, the greater Bay Area. However, we are getting a lot more downloads outside of California, on the East Coast, internationally. We're getting some in Italy, Paris, Japan, Asia, a lot of different places, which is exciting to see. I think there's an element of the Silicon Valley that always interests people, and I think that's the reason we get those downloads all over the world now. But the majority of them are still here in the greater Bay Area, here in the Silicon Valley. So before I sign off today, again, if you are watching the video, listening to the podcast, pass it on. Pass it on to your friends or family or coworkers. I know there's a lot of people on the fence right now thinking, should I wait? Are the prices going to go down more? Don't do it. Don't make the mistake. I've been in this long enough. Don't do it. If you are ready, don't try to time the market. Jump in now. I would argue, I've done this exercise before in examples of people. If someone said to me right now, Joe, I'm sitting across the table for them, they said, Joe, I'm looking at that buying that house for $1 million, but you know what? I'm looking at the market and it's kind of flat. And you know, what if it drops to $950 or $925 or $975? And I say, so what? If that's the house you really want, buy it now. And they'll say, well, what if it drops another $50,000? And my answer to that will be, it doesn't matter. Let me tell you why. If you pay $1 million for this house right now, let's just run this scenario, and you get a 3.5% interest rate, right? And then you pay $1 million. And let's just say the market's got a little more room, and 6 months from now or a year from now, that house goes down to $950. The same house. It's a year from now, and it sells for $950. But the interest rate's at 4.5% or 4 5/8 or 4 3/4. Guess what? You didn't win. Matter of fact, you lost, because the cost of money over that period of time will be more. Right? $50,000. I'm not meaning to downplay it, but $50,000 to $75,000 in the big scheme of things 20 years from now is nothing in terms of that property appreciation. The rate, the cost of money, is what you need to pay attention to and look for. Now, if it's a short-term play, it's different. If you're a flipper, or if you're looking to buy a house and you say, I'm out of there in 2 or 3 years, that's a totally different story. Then you got to be very, very careful, because anybody could get burned if you have a short-term approach on real estate. Anyone. So you have to be very careful with that. All right, again, for more information, feel free to reach out, Joe at RERadiolive.com. You could text, call 408-838-9060. Go out and take advantage of these great rates, and buyers, get off the fence and get going. This is Joe Kuchera with Real Estate Radio Live. Take care. Have a great afternoon.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.